Should I buy a condo, a co-op, or a house? I often get this question in my real estate practice. The correct answer is, as is usually the case, it depends. Generally, my next question is how well do you know the differences? This leads to an overview that most would-be buyers need and rarely get. It goes something like this. First, let's compare condominiums and cooperatives, which tend to be perceived as similar. Then we'll touch on houses. Condominium and cooperative ownership are just that, types of ownership. They are not limited to just apartments, though in the New York City vicinity, apartment-style condominiums and cooperatives are very common. You will sometimes find row houses, garden apartments, and duplexes under these constructs. Condominium units, or condos, are real estate or real property, just like houses. Cooperative units, or co-ops, are personal property with essentially the same benefits of real estate ownership. With condos, you get a deed to your unit, just like with a house. With co-ops, you buy shares of stock in the private company that owns the underlying real estate, and you receive a proprietary lease for your unit. With each, you pay a separate monthly fee that goes towards maintenance and management of the complex. You don't have to mow lawns or shovel snow. You just pay to have that done. With condos, this fee is called common charges, or sometimes an HOA fee, which stands for Homeowners Association. With co-ops, the term is maintenance. In both cases, you pay property taxes and insurance for what you own. With co-ops, it's included in the maintenance payment, which is therefore higher and often partly tax deductible. On the other hand, with condos, you pay it separately, just like with a house. And just like with a house, it's often added to your mortgage payment. So the lender pays it on time for you. So when people say maintenance is higher than common charges, just remember, it's really 6 in one hand, half a dozen in the other. You are paying for the same things, just in 2 different ways. Okay, so now let's focus on condos. There is a municipal tax lot associated with the individual condominium unit you purchase. The owner must follow house rules, which are generally far less restrictive than those of cooperatives. The owner will pay a monthly fee called common charges, which fund the maintenance of the complex, including things such as snow removal, landscaping, maintenance, heating and water costs, and so on. Like with a house, the owner is responsible for paying the real property taxes and unit insurance separately, though it is often tacked on top of the monthly mortgage payment and paid on the borrower's behalf by the mortgage servicer or lender. Typically, condos lack the common restrictions that exist in the case of co-ops. Of course, you won't be allowed to remove load-bearing walls or add skylights to the roof that the condominium maintains without permission, which you almost certainly won't get. But generally, pets are okay, remodeling your unit is straightforward, and renting out your unit is fine. Also, when you sell, you'll have the flexibility to sell to anyone you want, as long as they can get a mortgage to pay for it, but you don't need the approval of anything like the dreaded co-op board. All this said, it is a good idea to review the house rules prior to purchasing a particular condo to be clear on what you're buying. Now, a co-op unit is completely different. When you buy a co-op, you actually aren't buying real estate. You're buying an ownership interest in the private company that owns the real property, the real estate. You become a shareholder with a proprietary lease to your specific unit. You end up with the benefits of owning real estate, but you will not get a deed. Instead, you'll get a stock certificate or a photocopy of one. if you buy into the co-op with a loan. The mortgage company is going to keep the original until you pay them off. Because you are a shareholder in a private company, your experience in buying, owning, and selling your interest, we'll just call it your unit, your experience will be dramatically different compared to real property like condos and houses. For starters, as a private company, the co-op can legally discriminate and set its own rules for doing so. Don't panic though, they can't legally discriminate against protected classes, such as race, religion, gender, etc. They can, however, require that any purchaser put at least 20% down or more or less. They can require that a purchaser meet certain income requirements, etc. They can prohibit the purchase of a unit by lineal family members, such as a parent and an adult child co-purchasing a unit. During ownership, they can have rules prohibiting the renting or subletting of your unit to another for a period of time, say 1 to 3 years, or forever. In that case, this has the effect that when you move out, you have to sell your unit or continue to pay maintenance on a unit that is unused month after month after month. Co-ops can require that any significant renovations be approved by the board of directors or management company and may require you to use a specific contractor or one that meets their specific requirements. If they allow subletting of your unit, chances are your prospective tenant will have to be approved by the board. This may make it much more difficult to rent the unit. These policies can be changed while you own the unit. So what you buy today and what you have to sell in the future may be significantly different. Ultimately, these changes can affect the resale value of your property. Also, because the co-op company that you are a shareholder in actually owns the real estate, the company's financials are a critical factor. Your lender and probably your real estate transaction attorney will want to review the last 2 years' audited financials of the co-op. Think about it. Companies go out of business every day due to financial issues. If the co-op has been mismanaged, the stock could be or become worthless. High maintenance charges relative to what you get can be a red flag of financial issues in a particular co-op. Lenders may also consider ground leases on the land underneath the co-op building, which occasionally exist and can present a significant risk. When you sell, a co-op might encourage or even require you to use a specific real estate company. They may require you to pay a flip tax, sometimes called a waiver or a waiver of the right of first refusal, which is basically a co-op tax or a profit sharing mechanism allowing the co-op to share in your profit on your sale. The history of flip taxes is actually interesting, and there is an argument to be made that they promote the financial health of the company for the benefit of all current and future shareholders. But they have largely devolved into an unwanted closing cost, one which can vary dramatically. I've seen them as low as a few $100s, and in extreme cases, I've seen them as high as 25% of the difference between the purchase and sales price. Now that might be a $50,000 expense to a young grandmother that you know, or someone who may become one. Rather than being able to sell your unit to anyone that can pay your price, you will have to sell to someone that can meet the co-op's requirements. So now all the 5% down buyers that would happily pay your price to get into a home they can afford and get a loan for, those folks will likely be disqualified. You'll have to find your buyer from a smaller candidate pool. That 20% down payment buyer that makes X number of dollars and carries little debt. This means fewer buyers and less demand, pound for pound. You may have a few other important issues. You found a buyer that meets your co-op's published requirements, and not all co-ops publish their requirements. You've gone to contract, and over the past 2 to 3 months, your buyer has gotten their mortgage commitment, paid the application fee to the co-op, signed a recognition agreement and had it signed by their lender and ready for the co-op to sign. They've picked out their furniture, given notice to their current landlord, or committed themselves on the sale of their current property. You've gone to contract on the purchase of your next property. Everyone is happy and looking forward to the closing, which should happen in a week or two. The very last step before the closing is the dreaded board interview. Your highly qualified buyer meets with a few of your neighbors that have the time and maybe enjoy having a sense of power and are therefore on the board. The buyer spends a half an hour or so with them, answering their questions. The next day, their agent is notified that the board has denied the purchase application. No reason is given, as none is required, and co-ops, they don't want to open themselves up for lawsuits. The net result is you have to start all over again from the beginning. Now, this doesn't happen all the time, but it is not uncommon. Another consideration is finding agents that want to work on a co-op and that are skilled at selling them. Understand that the sales prices of co-ops are often low relative to both houses and condos. So they may have to charge a higher percentage commission to effectively do the job. This is less true in Manhattan, where co-ops are everywhere and generally expensive. So comparing that to, say, the outer boroughs and the greater New York metro area, it's less of a concern there. Also, selling co-ops are a lot of work and are paperwork intensive. So the agents can do a lot of work for absolutely nothing if the co-op rejects the buyer. As a result, many agents shun listing co-ops, and even more shun selling them for precisely these reasons. After all, if you had a choice to spend 2 to 3 times as much time and energy working on something that you might not get paid for, and if you did get paid, you might only collect 25% of what you normally get paid, how compelling would that sound to you? Now let's talk about houses. Houses provide the greatest bundle of rights with the fewest restrictions. While you are expected to follow municipal permitting and zoning requirements, you can generally improve and maintain your house however you'd like. You can rake your own leaves and shovel your own snow, or you can pay a company to do it for you, or hire local kids looking to earn a buck. You can put carpeting down if you want, or you can enjoy your hardwood floors without restriction. You are the king or queen of your castle. Your property will cost more and will be worth more. That said, the real important factors that will affect your decision are availability, pricing, and flexibility. In terms of availability, in our general area, there are far more co-ops than condos. Co-ops are like the haystack and condos the needle. But if you're in other parts of the country, co-ops may not even be a thing where you are. Remember, you also need to meet the specific co-op's requirements, and if you don't, those units simply are not available to you. Okay, pricing. Pound for pound, condos are generally significantly more expensive than co-ops because they provide the owner with more flexibility and less risk. That is, they provide a greater bundle of rights and far fewer restrictions. Also, while fewer financing options may work with a specific condominium, co-ops have the fewest financing options because you are not technically buying real estate. So now you're seeing why co-ops are generally less expensive than condos, though because of minimum down payment requirements and reserves requirements, you may need more money to buy a co-op versus a more expensive condo. Go figure. So which is better for you? Generally, if a house in an area where you are willing to live is beyond your means, or you just don't want to maintain a property beyond the living space you occupy, a condo or a co-op may be right for you. Often seniors who don't want to deal with stairs anymore may be particularly attracted to apartment-style condos and co-ops. If you have 20% down plus closing costs, plus good reserves, say 6 months worth, excellent credit, an established job that regular people would perceive as providing you stable, non-fluctuating income, and you're okay with the risks and limitations, co-ops could work for you. In the New York City area, you will have a good selection of co-ops. If any of those factors don't really apply to you and you can afford it, a condo or a house may be better choices. In many cases, you may be able to buy one with less money out of pocket compared to buying a less expensive co-op. One last note, the details always matter. The best option for you will depend on your specific situation and the market in which you find yourself. So make sure you are working with a high quality professional that can help you make the best decisions.